Disney now trading lower in the after hours after closing higher by more than 1% today. The recession definitely hurting its ability to sell ads and the amount of money people are spending at their theme parks. For a further breakdown of the report, let's go to Zara Burton. She's standing by in the newsroom. Zara?
And Matt, you have to recall that this company, Disney, came out and actually beat on the bottom line, came in at about 52 cents versus estimates for about 51 cents. But on the top line, that's where the problem lies. And that came in shy by about $200 million. $8.6 billion is what they came in at. Estimates were for about $8.8 billion. All divisions across the board saw declines. Interactive media down by the most, about 20%. And then on studio, down about 12%, even despite that successful launch of Up and also the proposal as well. And they're blaming lower home entertainment sales. They're also blaming lower worldwide TV distribution. Parks and resorts also seeing declines there, off about 9% to about $2.75 billion. They're talking about the fact that guests are just spending less when they actually do visit, and people just are not visiting as much. Hotel occupancy rates not doing as well either. Now, their biggest revenue segment, we're looking at the media networks, broadcasting down 4% to about $1.4 billion. But I really want to look at the cable picture because that was expected to increase based on the analysts I was talking to. Cable actually declined, Matt.
All right, Zara, thanks very much for that. We are joined for more on these Disney earnings by Pete Kwiatkowski. He is a portfolio manager at Fifth Third Asset Management. The firm owns more than 564,000 shares of the company, joining us from Cincinnati. Pete, let me get, first of all, your reaction. I mean, it seems in line with this earnings season where they beat a little bit on the bottom line and they kind of miss on the top.
Yeah, I think they're doing it with cost cutting right now. Obviously, Disney doesn't give guidance, so it's not a big surprise that it's a little bit off on the revenue line. And I think that if they were going to miss anywhere, it's there. It's good that they were able to still hit the number. And the other good thing is that they're keeping traffic going, even though it's a pretty difficult environment, as we all know. Orlando and our work earlier this year was really not looking good, and so they needed to promote to get people in there. At least they're getting the traffic in there, and they're trying to manage it as well as they can. Could
this be, though, a practice that turns around and bites them in the end? I mean, customers may be getting used to discounts, and if they don't continue that, they might have problems with customers just not showing up later.
Yeah, that's true. That's always a risk. When the economy recovers, what do you do? I think their tack in this environment, I think, is the right one, though. Try and go out there, take share, because people are being a lot more selective. You still want to continue to get families there. You've got a lot of fixed costs in that system, so you need to get the traffic in there.
You say when the economy recovers. We've heard so many economists and market people saying it's at least stabilizing here. Do you hear that from Disney as well? I mean, what do you hear about the state of the economy from the company?
Well, we, looking at what they're saying on the call right now, they're seeing some stabilization. We've been a little bit pessimistic about that ourselves. I mean, I think we're kind of taking a wait-and-see approach here. I think it's going to be kind of a drawn-out process. We do think there are going to be some winners and losers out there, both in retail and in the entertainment industry. And we do think the ones that are going out there to try and manage cutting the costs, doing some discounting. You don't want to get crazy with it, but you do need to try and take share in this environment if you're going to survive, and there's going to be some big winners and some big losers out there. We do think Disney's kind of leaning into the winning side, but it's going to be they're walking a high wire with this because, again, they've got a lot of fixed costs in their system, and they need to get that traffic in there.
Speaking of taking share, I mean, they have been doing pretty well on the entertainment side. On the movie side, what are your thoughts on their performance so far and the outlook?
I think they're hanging in there. Definitely not a home run by any means this summer, but they're keeping it going. Domestic looked like it did a little bit better than expected, so that's good. They have to keep that machine going, though, and going forward, it's going to be managing that content and squeezing as many dollars as they can out of the content. There's always a lot of investment going into these projects. Up is doing well. But they need to continue to keep the machine going. It's not getting any easier. They just have to be nimble about how they're managing, distributing their content and maximizing it as well. Where do
you think the shares should be fairly valued? They're at 26, 22 right now. What do you think is a fair value for Disney?
I think, Disney's probably trading right around fair value right now. Again, I think it was leaning a little bit more positive going into this earnings. So, we expected there might be a little bit of a pullback, but, I think there's some long-term value there. There's 15% growth kind of embedded in for next year, and I think that's kind of the key as we get through the next quarter or two, whether that's realistic or not. If that's realistic, I think we can probably see $30 in the stock, around the end of the year going into the beginning of next year.
All right, Pete, thanks so much for joining us. Pete Kwiatkowski there, a Fifth Third Asset Manager.